At midnight, while the West was asleep, China flipped a switch. It wasn't a military strike. It was a quiet update to a trade regulation. Effective January 1, 2026, China reclassified silver as a strategic national asset, placing its export under a strict new licensing system. With this single move, Beijing seized control of roughly 70% of globally traded refined silver. The physical price of silver is already exploding in Asia. In the first weeks of January, we saw physical prices spike to over $83 an ounce in trading hubs like Tokyo and Dubai. Yet, if you look at the COMEX screen in New York, you'll see a paper price hovering around a laughable figure in the low 70s. This isn't just a market difference. It's like finding out the physical deed to your house, and a monopoly paper version of that deed are suddenly trading for two wildly different prices. One is real, the other is a game, and the game is about to end. In this video, I'll show you the chain reaction that has already begun, a process set to trigger a cascade of delivery defaults, vaporize the paper bets of Wall Street's biggest banks, and ignite a firestorm in the Western banking system. What you're witnessing is the birth of a two-tier market. Think of the silver market as a giant coat check room. For years, Wall Street has been issuing millions of paper tickets, but they only have a handful of actual coats in the back. On one side, you have industrial giants in Asia, the makers of solar panels, EVs, and semiconductors, panic buying every physical ounce they can find. They are the people showing up demanding their actual coats because they need them to stay warm. This isn't speculation, it's desperation. This industrial panic is layered on top of a structural deficit that's been building for years. The world consumed over 820 million more ounces of silver than it mined between 2021 and 2025 alone. For years, the West ignored this growing shortfall, relying on China to fill the gap. That reliance just became a strategic vulnerability. So, how is the paper price in New York still so low? The answer is manipulation. In late 2025, as silver's paper price finally started reflecting reality and rocketed towards $84 an ounce, the CME Group, which owns the COMEX, stepped in. They aggressively hiked margin requirements. This is like a casino seeing you're about to win big at the poker table and suddenly charging a massive fee just to stay in the game, forcing you to fold your winning hand. It crashed the paper price and saved the massively short bullion banks from immediate ruin. But they didn't fix the problem, they only delayed the reckoning. So what does this all mean? It means the fundamental lie of the silver market is being exposed. For decades, a handful of Western banks have built a castle of paper promises on a foundation of physical metal they do not have. Through the derivatives market, they sold claims on hundreds of millions of ounces of silver they don't own. They always assumed they could cover their paper bets with more paper, because China acted like a global ATM, always ready to dispense physical silver and keep prices low. China just unplugged the ATM. By ring-fencing their domestic supply, they haven't just choked off the majority of the world's traded silver, they've effectively called the West's bluff. They are forcing a physical reconciliation in a market that was designed to run on paper forever. The banks bet that silver was just a number on a screen. China is reminding them that it's a strategic industrial metal, and they now control the flow. If you value clear thinking in chaotic times, take 1 second right now to like this video and subscribe. We cut through the mainstream noise to bring you the analysis you need to understand what's really happening as this crisis unfolds. Here's where it gets worse. The system is cracking right now. The vaults that underpin the entire paper market are being drained at an alarming rate. The game has always been like selling 500 tickets for a 10-seat private jet, assuming everyone would just trade the tickets among themselves and no one would actually want to fly. That only works as long as the ticket holders don't show up at the airport. Now, they are all at the gate, demanding their seats, and they are discovering the jet barely exists. Buyers are now standing for delivery. They don't want the cash, they want the metal, and the signs of stress are undeniable. We're already hearing reports of major industrial buyers struggling to source physical bars and being offered cash instead. Think about that. The very heart of the market is telling clients they can't have the metal they supposedly bought. This is the beginning of a structural default. It's a bank run on physical metal, and the vaults are getting dangerously empty. Now let's connect the dots to the banking crisis. This is brutal math. Let's run a hypothetical. Imagine a ticket scalper pre-sells 100 million ounces of silver for $73 each, betting he can buy them later for cheaper. But now a wave of clients demands the physical silver. The scalper, the bank, has to go into the open market to buy the metal. But the only physical metal available is trading at $117 an ounce. He is legally forced to buy high to fulfill the order he sold low. That's a $44 loss on every single ounce. Multiply that $44 loss by his 100 million ounce short position. That is over $4 billion in losses for just one bank. Now multiply that across all the major banks caught in the same trap. You're talking about a black hole of losses, so large it threatens their very solvency. This is the margin call from hell. When the game of musical chairs stops, someone is left without a seat. China just took away most of the chairs. Make no mistake, this is not just about silver. This is about the end of an era. The era of paper wealth, created out of thin air, is crashing into the hard reality of physical limits. China's move was the catalyst, but the crisis was inevitable. Even the bank's own analysts see the writing on the wall. We're seeing major institutions forced to dramatically raise their price targets for 2026, but those are paper targets. They are forecasting the managed price, the one the CME will desperately try to control. The true physical price has already left that far behind. What we are witnessing is a global economic war being fought not with missiles, but with commodities. It's a calculated move to expose the fragility of the Western financial system, a system built on debt and paper leverage. By cornering the silver market, China is demonstrating a painful truth. Wealth is not a number in a bank account. Wealth is real things. It is energy, resources, and strategic metals. So, what should you watch for next? The February COMEX delivery reports. That is the next major battleground. Watch to see how many contracts stand for delivery and demand the physical metal that isn't there. Watch for more stories of delivery delays and cash settlements being forced upon buyers. Because this isn't just a silver squeeze. It is a controlled demolition, and the foundations of the Western banking system are shaking. The same forces driving this silver crisis are putting immense pressure on the gold market. To understand how this shockwave will impact gold, click and watch our video on the Great Gold Unwind right here on the screen. Protect yourself with knowledge. Thanks for watching.